A single generative AI query requires roughly 10 times as much electricity as a standard web search. Now, imagine dropping 50 massive hyperscale AI data centers into a single Southeast Asian state in less than 3 years. We aren't just talking about a tech boom anymore. We are looking at the largest, most aggressive concentrated power grab in modern infrastructure history.
Welcome back to Asia Tech Macro. I'm Maya, and today we are shifting our focus to the physical backbone of the AI revolution. We're looking at the explosive, multi-billion-dollar data center gold rush happening right now in Johor, Malaysia. Almost overnight, the state has transformed into the undisputed hardware capital of Southeast Asia.
I'm Alex. Let's look at the data. Over the past couple of years, we've seen an absolute tsunami of capital flooding into Malaysia. Microsoft, Google, NVIDIA partnered with YTL, and ByteDance has collectively committed well over $15 billion to build out advanced AI infrastructure, overwhelmingly concentrated in the Johor region.
Wait, really? $15 billion into just one state? I knew Southeast Asia was growing, but that concentration of capital is staggering. Why Johor? Why not just build these facilities in Singapore, where all the regional tech headquarters and financial hubs already are?
Because Singapore physically ran out of space, and more importantly, they ran out of power. A few years ago, the Singaporean government actually had to issue a moratorium on new data centers because they realized these facilities were on track to consume an unsustainable percentage of the entire nation's electricity grid. So the hyperscalers did what they always do. They looked for a loophole. They looked directly across the Causeway Bridge to Johor.
So they get the proximity to Singapore's world-class undersea internet cables and financial latency, but with Malaysia's significantly cheaper land and subsidized electricity. That makes perfect financial sense for the tech giants.
It makes perfect sense for their margins, yes. I was just reading this morning that Johor's total data center capacity pipeline, meaning what is currently live, under construction, and in the immediate planning phase, has crossed a staggering 2.5 gigawatts. To put that in perspective, that is the equivalent power consumption of roughly 2.5 million homes running 24/7 just for server racks.
2.5 gigawatts. That is unbelievable. And the local financial markets have to be pricing this infrastructure supercycle in, right?
Oh, they absolutely are. If you look at the Malaysian Stock Exchange, the companies that own the grid and the pipes are flying. Tenaga Nasional Berhad, the national utility monopoly, and YTL Power International have seen massive surges, in some cases their stock prices doubling over the last 18 months, simply because they hold the physical keys to the electricity required to run these AI models.
That is the ultimate picks and shovels play. Forget buying the AI software wrappers, buy the local utility company selling the megawatts. Okay, but devil's advocate here. You can't just plug 2.5 gigawatts of continuous high-density power demand into an emerging market's power grid without fundamentally breaking something, right?
You can't. And that is exactly where this utopian Silicon Valley infrastructure narrative hits a massive physical brick wall.
Okay, wait. You can't just plug 2.5 gigawatts of continuous high-density power demand into an emerging market's power grid without fundamentally breaking something, right? You were about to hit the brick wall on this utopian narrative.
Exactly. And the brick wall is physical constraint. The narrative right now is Malaysia is the new tech hub of Asia, but the reality is that the hyperscalers are essentially executing a massive energy arbitrage. They are strip mining cheap electricity and subsidized water from an emerging economy to process complex mathematical calculations for high-margin US software products.
That reminds me of what happened in 2022 when the crypto mining boom hit Texas and Kazakhstan. It looked like great local investment on paper, but when winter storms hit, the local grid couldn't handle the strain, and citizens were suddenly competing with Bitcoin miners for basic electricity to heat their homes.
Precisely. And generative AI is exponentially more resource-intensive than Bitcoin mining. These aren't just standard servers. These are high-density NVIDIA H100 and B200 clusters. They run incredibly hot. You can't just blow air on them anymore. You need advanced liquid cooling. Which brings us to the second, much quieter crisis in Johor: water.
Right. Data centers use millions of gallons of fresh water a day just for evaporative cooling towers. And Johor already has a complex history with water management. Don't they historically supply a massive portion of Singapore's fresh water under a decades-old agreement?
They do. It's a highly sensitive geopolitical issue. I was reading a recent analysis by James L. Green, a researcher tracking Southeast Asian infrastructure at the IEEAS Yusof Ishak Institute in Singapore. He pointed out that while the Malaysian government is rolling out the red carpet for foreign direct investment with tax holidays and expedited approvals, the local municipalities in Johor are quietly panicking about the long-term strain on reservoirs and the power grid. Green explicitly warned that the current pace of data center approvals in Johor is simply incompatible with the existing medium-term infrastructure rollout plans of the state utility providers.
So the national government in Kuala Lumpur gets to announce the glowing $15 billion foreign investment headline, but the local mayor in Johor Bahru has to figure out how to keep the lights on for his actual citizens.
That is the exact dynamic, and this creates a massive ripple effect across the entire ASEAN region. Because the hyperscalers aren't stupid, they know Johor will eventually hit its absolute physical limit, just like Singapore did. So now we are seeing the beginning of a pan-Asian infrastructure scramble.
So they are diversifying the grid risk. Where is the capital moving next?
They're starting to look at secondary hubs. Indonesia is heavily pushing the Batam Island economic zone, right next to Singapore, trying to replicate the Johor model. Thailand is aggressively courting Google and Microsoft with promises of dedicated renewable energy zones. Even Vietnam is trying to get into the game, though their national grid is notoriously fragile. They literally had to ask Foxconn to reduce power usage during a heat wave a few years ago.
It's a complete race to the bottom for energy subsidies. But there is a massive contradiction here, Alex. All of these tech giants, Google, Microsoft, Amazon, have very public, very aggressive net zero carbon emission pledges by 2030. If they are dumping 2.5 gigawatts of power demand into Malaysia, and the Malaysian power grid is still overwhelmingly powered by coal and natural gas, how on earth does the math work on their climate pledges?
It doesn't. That is the dirty little secret of the AI boom. The energy demands of generative AI have completely blown up the corporate sustainability models of the last decade. They are buying carbon credits to offset the emissions on paper, but the physical reality is that they are actively increasing the carbon footprint of Southeast Asia.
That is the dirty little secret of the AI boom. The energy demands of generative AI have completely blown up the corporate sustainability models of the last decade. They are buying carbon credits to offset the emissions on paper, but the physical reality is that they are actively increasing the carbon footprint of Southeast Asia. But let's step into the contrarian corner, Alex. The entire consensus right now is that this $15 billion data center boom is an unstoppable juggernaut for Malaysia. Everyone assumes that because Microsoft and Google are building the physical walls, the massive economic benefits, the jobs, the tech transfer, the local innovation, will naturally follow for decades. What is your contrarian take?
My contrarian view is that this entire data center miracle is actually the worst possible type of foreign direct investment for an emerging economy. The consensus thinks Malaysia is becoming the next Silicon Valley. I think they are becoming the world's most expensive air-conditioned storage closet.
Wait, really? A storage closet? You just spent the last 10 minutes talking about the staggering $15 billion in capital expenditures flowing into Johor. How on earth is that the worst kind of investment?
Well, actually, let me rephrase that. It's great for the construction companies pouring the concrete and laying the steel today, but look at the long-term economic multiplier. Unlike a semiconductor fab or a massive automotive plant that employs thousands of skilled local engineers and creates a deep supply chain of local parts manufacturers, a hyperscale data center is essentially a ghost town.
That's a good point. Once the building is finished, how many people actually work inside one of these massive facilities? A couple dozen security guards and a handful of HVAC technicians?
Exactly. The servers run themselves. The algorithms are written in California or Seattle. The actual high-value intellectual property, the generative AI models, the cloud computing architecture, stays completely walled off inside the US tech companies. There is virtually zero technology transfer to the local Malaysian economy. They are trading their cheap electricity and subsidized water for low-wage security jobs, while the massive high-margin software profits flow right back to the US.
Okay, but devil's advocate here. Even if there aren't direct jobs, isn't the tax revenue from these multi-billion-dollar corporations massive for the Malaysian government?
No, because they gave it all away. Remember what James Green from the IEEAS Institute pointed out. To lure these tech giants away from Singapore or Indonesia, the Malaysian government handed out massive multi-year corporate tax holidays and designated these areas as special economic zones with zero import duties on the expex and server equipment. So the government isn't taxing the profits, and they aren't taxing the hardware imports.
So wait, if they aren't taxing the profits, and they aren't taxing the equipment, and the data centers don't create high-paying local jobs, what exactly is the local economy getting out of this 2.5 gigawatt power drain, other than a massive strain on their own water reservoirs and power grid?
They get the headline. Politicians get to stand in front of a ribbon-cutting ceremony with the CEO of Microsoft and claim they are building the digital future. It is the ultimate political vanity project, masquerading as economic development. And here's the kicker. If a new, more efficient cooling technology emerges in 5 years, or if Indonesia suddenly offers electricity for half the price, these tech giants will abandon those concrete shells in Johor without a second thought. They have zero loyalty to the physical location.
That is a brutally cynical but highly realistic assessment. It is digital strip mining. Which brings me to a really sharp question, Alex.
If this data center boom is actually a margin trap for the host country, but an absolute necessity for the U.S. tech monopolies, how do investors actually play this infrastructure cycle without getting burned when the subsidies inevitably run out?
You play the physical bottlenecks, not the political headlines. If you want to actually generate alpha from this $15 billion Southeast Asian data center boom, here are 3 specific action items to position your portfolio before the grid constraints truly hit.
I have my notepad ready. How do we play this digital strip mining cycle?
Action item number 1. Go long on the regional monopoly utility and grid infrastructure companies. I mentioned them earlier, but companies like Tenaga National Berhad and YTL Power in Malaysia are the ultimate gatekeepers. It doesn't matter if Microsoft or Google wins the AI software war. It doesn't matter if the local government gave away all the tax revenue. These utility companies are legally contracted to sell the actual megawatts required to keep those servers from melting down. They have guaranteed massive volume growth locked in for the next decade.
Right, they are the ones collecting the toll on the energy arbitrage. That is a very safe physical infrastructure play. What is the second action item?
Action item number 2. Invest in advanced thermal management and liquid cooling suppliers. The era of just blowing cold air through a server rack is completely dead with these new NVIDIA chips. You need highly specialized direct-to-chip liquid cooling systems. Look at global industrial players like Vertiv, Schneider Electric, or specialized Asian component manufacturers that supply the actual plumbing and cooling infrastructure for these hyperscalers. When Johor inevitably hits its strict water usage limits, the companies providing ultra-efficient closed-loop cooling technologies will have infinite pricing power.
That makes total sense. As the physical resources dry up, the efficiency technology becomes the most valuable asset in the building. Okay, what is the third move? What should we be avoiding?
Action item number 3. Avoid local commercial and retail real estate developers hoping for a Silicon Valley halo effect.
Because the data centers are essentially ghost towns.
Exactly. Do not buy into the narrative that building a $2 billion data center in a special economic zone is going to suddenly create a booming local ecosystem of high-paid tech workers who need luxury apartments, premium coffee shops, and Class A office space. It won't. The servers don't drink lattes. The data centers drive up the underlying industrial land and power costs, but they do not generate the localized white-collar consumer spending that traditional real estate developers are modeling for.
That is a phenomenal reality check. If you build it, the servers will come, but the engineers will stay in California. So the ultimate takeaway for today is clear. The $15 billion data center boom in Malaysia is an unprecedented infrastructure land grab. The hyperscalers are executing a brilliant energy arbitrage, but for the host countries, it's a massive strain on local power and water resources, with virtually zero technological transfer.
Precisely. It is the colonization of physical electricity for digital margins.
In our next episode, we're heading to India. Apple is aggressively shifting its iPhone supply chain away from China, and Tata Group is leading the charge in building massive local electronics manufacturing hubs. We will look at whether India's infrastructure and labor force are actually ready to replace Shenzhen, or if the Make in India initiative is just another overhyped political headline.
The logistics and yield rates on the ground in India tell a fascinating story. We will dive deep into the real numbers behind the China Plus One manufacturing shift.
Can't wait for that discussion. Thanks for listening to Asia Tech Macro. If you found this breakdown helpful, please share it with a colleague or a friend who is trying to understand the physical reality of the AI boom. Stay data-driven.
Bye.